As a veteran or active military member, your qualifying debt-to-income ratio does not matter all that much. Welcome to More About Mortgages, guys. My name is Ian Moore. I'm a loan officer here with Premier Mortgage Lending. Thank you for joining me here with another episode. Today we're talking about residual income, in particular towards veterans and active military members using their home loan benefits. Whether an active homeowner or existing homeowner or a home buyer that is a veteran or active military member is going to use their VA home loan benefits to purchase that home or refinance, then it's not necessarily your debt-to-income ratio that the lender and the underwriter is going to look at for qualifying purposes. It's more your residual income. And residual income is a term a lot of folks don't really know too much about. And with veterans and active military members using VA loans, that's everything. Because I've had VA loans qualify with upwards of a 65% debt-to-income ratio, 70% debt-to-income ratio I've heard people say before they've qualified with a VA loan. That's nuts, because the maximum debt-to-income ratio on conventional loans, you're looking at 45, maybe 50% if there's mitigating factors like a great credit score. But FHA loans, you're lucky to get up around 50% debt-to-income ratio as well. So the fact that with VA you can go as high as 70% debt-to-income, that's pretty crazy. And debt-to-income, just so you folks out there know, is essentially your gross monthly income divided by the amount of debt that you pay on a monthly basis. So car payments, student loans, credit cards, and essentially you take that debt and divide it by your gross monthly income. So if you have a mortgage payment, it's that mortgage payment, principal, interest, taxes, and insurance, plus your car payment monthly, your student loan payment monthly, your credit card payment monthly, divided by your gross monthly income. If you're self-employed, it would be your net monthly income, line 31 on your Schedule C after taxes and expenses. So you would think on any mortgage loan, that would be the basis of qualifying, and it's an important factor. It is, and even with VA loans, it's still looked at as an important factor, but it doesn't matter all that much because you can have a high debt-to-income ratio and still qualify with a VA loan. And VA loans, guys, they have a stigma in this industry that they're looked at as FHA loans, that they have more stringent appraisal or inspection services, that essentially things that may not pop up on a conventional loan will pop up as being subject to and need to get repaired before closing with a VA loan. It's not necessarily the truth always, guys. A lot of the guidelines kind of match up, and VA loans have taken a hit, essentially, and have received a bad name, and have been aligned with FHA loans essentially for the last decade or so, when it's not necessarily the case. The VA home loan is a great loan product, and for veterans and active military members, it's the best way to go. 100% financing, no down payment, no PMI, and awesome rates. So they're great loans, guys. And today I'm going to explain residual income. So you veterans and active military members out there, whether you have an existing VA loan or you're going to be buying a house in the future, you know exactly what you're getting in for. Heck, you might even be able to calculate your own residual income after this. Residual income is the amount of money left over on a monthly basis after paying all your bills. For example's sake, to explain residual income, Alex has about $5,000 a month in income. Alex takes home $5,000 a month. Right now he's paying a nice car payment of about $800 a month, which is a pretty steep car payment for his income. He likes to drive nice cars. He has a student loan payment of $100 per month. He's finishing up his student loan, still paying $100 a month minimum payment. And then a credit card that he pays $50 a month on. So all in all, he's looking at $950 a month in overhead or non-mortgage payments compared to his $5,000 a month in income. So ultimately, you take that $950 and divide it by his gross monthly income. So $950 in total monthly debt divided by $5,000 income, he's only at a 19% front-end debt-to-income ratio. Now, if Alex is going to be looking to buy a house, essentially, he's going to have a mortgage payment included in that debt. Let's just say Alex is looking at $300,000 to $400,000 range. He's got a girlfriend. He's looking to move in and start a family. He's going to be buying a house around $400,000 or $500,000. For this example's sake, let's just say he finds a property for $400,000. Now he has a loan for $400,000 and a new mortgage payment of $2,000 added on to his $950 existing monthly debt. So $2,000 plus $950 is $2,950. You take that and divide it by his total monthly income of $5,000. He's now at a 59% debt-to-income ratio. With a conventional loan, it doesn't matter if Alex has an 850 credit score. He's not going to qualify. That is exceeding the limit. FHA, He might qualify if he has a terrific credit score, but 59% is pushing it with FHA every time. USDA, you're not going to qualify over 43% back-end ratio, which back-end includes the mortgage payment. Here's where it comes into play, residual income with the VA. Now, residual income doesn't look at that debt-to-income ratio. It looks at the remaining amount of money that Alex will have after paying all of his bills, which in this particular case, you're looking at $2,950 deducted off of $5,000. You're looking at $2,050 that he'll have as residual income on a monthly basis. Now, the VA has a system and a chart essentially to use for lenders and loan officers to calculate what their eligibility is based on that residual income, but that's getting into things that you guys don't necessarily need to know. All you really need to know is that with a VA loan, it looks at, for qualifying purposes, that residual income and that leftover money on a monthly basis that you don't apply towards your monthly payments instead of debt to income ratio, which DTI, always important, guys. If you're not a veteran out there, look at this video, take a look at your own debt to income ratio, see what you're at. Again, it's your monthly debts, car payments, credit cards, student loans, plus any mortgage payments, principal, interest, taxes, and insurance, divided by your gross monthly income, or for self-employed borrowers, you're looking at divided by your net income, or your line 31 Schedule C. So, active military members, veterans, keep in mind, guys, residual income plays a huge factor in determining your qualifying ability, not your debt to income ratio. Thanks for joining me for another episode of More About Mortgages, guys. I hope this was helpful and informational. Please give me a call if you need anything. Take care.